to TheoTrade. This is Don Kaufman. It's November 29th, 2019, and you are watching the TheoTrade Weekend Update. Yeah, broadcasting here from none other than Payson, Arizona. Yes, I am outside. Yes, it is snowing. Yes, it snows in Arizona. Nevertheless, let's get down to business. First and foremost, I want to thank everybody for all of the support over the years here at TheoTrade, and because of that, we are going to once again offer our Black Friday special. You will find a link associated just below this video with that Black Friday special. Numerous requests have actually come in over the last couple of weeks requesting, again, specifically that we offer that Black Friday special. So again, that link is associated, of course, with this video. By the way, for those of you, if you're enrolling for another year of TheoTrade, again, we thank you, and wait till you see what we have planned for 2020. It's going to be quite spectacular. With that, let's get down to business and talk a little bit about the broader markets. You know, one of the things that I'm ready to kind of call an end for is this kind of positive gamma grind. That is, week in and week out, we've seen the markets kind of grind to the upside. I've got a little bit of statistics behind that. One of the things that's bothersome to me, to say the least, is that the SPX expected move. Now, the expected move, that's something we look at every single week, right, on these weekend updates. The SPX expected move coming into this next week of trade is about $37. This last week of trade is about $27. I'll show that in a minute when I get to some charts, a couple of trade ideas. Nevertheless, we're going on now 17 weeks without a significant breach of expected move. Again, to be elaborated upon here in a moment. So 17 weeks, we're just getting wound up into this kind of positive gamma trade. Things are what? Okay, getting tighter and tighter and tighter in terms of risk. Okay, one of the other aspects that I'm ready to call here as well is that we think we've seen now historical volatility finally bottom out, and that is actual price movement inside of, again, specifically inside of the S&P 500. Does appear that it has now finally bottomed out, so we're going to see more actual price movement on a day-to-day basis moving forward. But really, the sticking point with all of this is, in the recent weeks of trade, and really almost that entire 17 weeks that we've been inside and packed inside those expected moves, we've seen this constant kind of rotation of capital from one sector to another. And I'll just give you an example. You know, a couple of weeks ago, financials, hottest thing ever. Then it actually rotated. Like this past week, we actually saw consumer discretionary. You know, about 2 weeks ago, you know, we had what? Healthcare. And I'm going to show you that again in a chart. So we're seeing these capital rotations, but we're not correlating. What not correlating means is that the marketplace, an example is like the S&P 100 on a day-to-day basis as we trade, you might see 60 stocks up, maybe 70 at most, but what we're not seeing is like 90 stocks on one side or the other. And that is something that I do believe we're going to start to see again in the first weeks of December here. So that correlation is, okay, in effect going to knock us out of this positive gamma, which is that positive gamma grind that's just kind of winding us up and driving the markets a little bit higher. We think, again, that we are, in fact, ready to actually, well, we're going to start to rock a little bit again. Historical volatility is going to start to head a little bit back up. We're going to see better, okay, degrees of correlation. All of that to be explained here momentarily. And last but definitely not least, I'm going to explain a little bit about where I personally believe interest rates are about to head. With that, let's get down to it. Let's look at a couple of charts, a couple of trade ideas. Thanks everybody once again for joining us here at TheoTrade for the weekend update. To the charts and trades we go. All right, let's jump right into it, talking a little bit about the SPX and its expected move. So for those of you that are maybe a little newer to TheoTrade, well, on a week-to-week basis, we look at what we term expected move. And the expected move, people, is incredibly important, especially, okay, in the last few weeks, okay, this entire, what we kind of term positive gamma grind, okay, is all about evidence of this expected move. Now, again, if you're brand new here, you haven't necessarily tuned into TheoTrade week in and week out, okay, each week we kind of define what the S&P 500, okay, has a high probability or likelihood of moving. And you can see in this last week of trade, $27.42. Next week, we're looking at $37. First and foremost, where do those numbers come from? Okay, so all the expected moves that you're seeing, okay, are hand drawn onto your SPX chart. We enjoy sharing those. We share actually a link for the SPX expected move pretty much on a week-to-week basis here so that you have the most up-to-date expected move. Nevertheless, I'm going to take you through just a very brief synopsis of how I actually derive that, why I put it on the chart. So I'm going to cruise over here to the trade tab. I'm actually going to come precisely, 1 week out. Now, I look exactly 1 week out, and I always use the PM settlement options, exactly 7 days out. And I look over here to the right-hand side of the screen. It says, lo and behold, $37. So there's our expected move, Then we take that expected move, all right, and we effectively draw it on the chart. But what it really breaks down to, and before I go too far, what it really breaks down to is this, We'll draw a little distribution curve, Here's the market right here. What's here? All right, let's call it 31.40. This marketplace in the next week of trade is positioned to move up $37, or down $37. And it's supposed to stay in that range approximately, 68% of the time. Now, yeah, I've explained this in, a million different videos over time, but why now? Why now? Well, because there's a statistically significant almost aberration that's going on right now. And that's, we've had 17 weeks without a major breach of expected move. I mean, you got to realize like markets, they do in fact have financial memory, even if it is short-term financial memory. If I kind of zoom in on this, all right, you can go ahead and count back. This is the last major breach of expected move, And to give you really specifics on that, I'll kind of zoom into it. The last major breach, was actually the week that ended, well, August 1st. Every week thereafter, we have basically, been what? Inside the expected move. Now, there's a few weeks where we're right on the cusp of it, but you have to understand, this is a $3,000 product. That's pretty much a rounding error in there. In fact, even this week, how close are we to the edge of the expected move? Well, the edge of the expected move, and it was supposed to be a $27.42 move, there it is at 31.37. We closed at 31.40. I kind of call that a rounding error. I mean, you're 3 points off. Literally, people, you're 3 points off in a $3,000 product. I mean, it's incredible. That's like hitting the head of a nail from 200 yards away by, throwing a rock at it. I mean, that's how insane and how efficient this marketplace has been. And because it's been so efficient, it's actually one of the reasons that I'm calling for this market grind is coming to an end. I'm going to get into details about that. So what is imperative to understand, 17 weeks, without a major breach of expected move. On top of that, we believe that historical volatility, bottoming in the index products. Now, if you haven't looked at historical volatility, you can cruise over to studies, all right? Come over here to add study, get on to volatility studies, cruise up to historical volatility. The annualized standard deviation of past stock price movement. You know what? You can pull up historical volatility for quite some time. And again, this is just an annualized historical volatility. You can pull it up for like 3 years, We are not the lowest, but one of the lowest points of historical volatility, And it's annualized, and this is a daily historical volatility, annualized over 20, averaged over 20 days. We're at one of the lowest points of that volatility. Nevertheless, we are seeing a little bit of an uptick. I believe that we've actually seen some of the bottom in terms of actual price movement. What that effectively means, is markets from this point forward, we expect it to move more. Actual price movement in here, we expect markets to effectively move a little bit more. Now, on top of that, you'll also see an expansion of next week's expected move. So let me just give you a contrasting kind of view over here. If you take a look here in the, again, the SPX, see last week's expected move? Yeah, but last week there's a holiday, We had Turkey Day in there, Thanksgiving. We had a half a trading day on Friday, And this next week of trade, which is, again, the first week of December, we're actually bumping up to a $37 expected move. And yet at the same time, I'm telling you right now, keep trades defined, keep your hands and feet inside of the vehicle at all times, because if and when we do breach this, and this is the big takeaway, I am not going to try to handicap, precisely when we start to break out of these expected moves. Not going to do that, but I am going to tell you this, the longer we are efficient. The tighter we get wound up, the more that this negative gamma trade pushes us, every single week becomes that much more dangerous. Last week I was talking about that kind of grind. I mean, we're getting wound up like a top. And at this point, after 17 weeks, as I said, markets do, in fact, have degrees of financial memory. And I'll tell you why they have degrees of financial memory. Because in products like the SPX, people just keep rolling the positions forward. All these trading firms roll the position forward, okay? And it all works until it doesn't, okay? And again, markets right now, it's dangerous. 17 weeks without a breach of expected move, historical volatility bottoming. Again, whatever you're doing, keep that stuff defined in there and just recognize, okay, how much risk we're actually building into. Now, I wouldn't be surprised. I've said this in the past before, and you'll notice I'm not here dictating that we're going to drop like a rock. There are times where you got to go up to go down. And there's absolutely like a risk reward associated with this. So I'll make this very, very evident. We could actually explode higher before we actually come off hard and fast. And maybe this is the explosion higher before we come off hard and fast. And that one, hey, listen, okay, again, you can't handicap that type of a move. So all of a sudden a negative gamma grind can actually just free fall. And what makes me nervous again is how many positions are being rolled forward. And I was talking about on last weekend's video as well, the number of short volatility traders right now is just absolutely disgusting, because when volatility does start to pick up, all of those short vol traders are going to have to cover, okay? And it's going to amplify all of the risks inside of the broader marketplace. And I hope we're all clear. Yeah, I'm looking at the SPX, but I'm talking about the entire marketplace as a whole. Okay, everything that you do in a marketplace, whether it's investments, whether it's trades, it all pertains to right here inside of the SPX. I mean, people, this is the mother of all products. It is the beast. And this is what moves markets. And, you look at stuff and you're like, it's economic data, it's this, it's that. I'm going to talk about that here in a moment. But in the end, okay, it's trades and it's trading activity. It's option activity. I mean, we just came off of like what? A half a trading session here on a Friday. Do you realize, okay? Do you realize on a Friday with a half a trading day, the SPX still does just shy of 1 million contracts? It's a slow day. Just shy of 1 million contracts. Yeah, almost 1 million contracts of a $140 product. Okay, stand back. This thing's the beast. Moving forward, the merry-go-round of horrors. One thing that we've also, kind of forgotten about, we've heard a lot lately about this trade war, okay? And, the trade war at this point, listen, Chinese trade war, it's either deal or no deal, okay? Deal or no deal at this point forward. At any point in time, we could see a tweet, okay? It's either done or not done. I'll tell you what, the marketplace, strictly my opinion, has actually priced in far too many positive attributes of this phase one deal. And whether it's a deal or not a deal, I think that's actually a negative weight on side, in terms of the marketplace. But what I'm getting to with this merry-go-round of horrors is, you'll hear for 3 weeks straight, you'll hear all about the Fed. And then all of a sudden the Fed, right now, they're out of the picture, right? So now we're actually listening to about the trade war. Okay. And by the way, the ones that are about to come up, and again, it's just a merry-go-round. We just keep going around the circle, around the circle, around the circle. Where we stop, nobody knows. I think we're actually coming back to interest rates. Interest rates, yield curve, and there's actually a TLT trade that I'm going to show you here in a minute. But economic data is what's actually going to drive us to talk about interest rates again. Economic data has been scattered, broken, maybe a little bit better than we anticipated in some parts of the world. But Chinese data was horrible. Japanese data was horrible. The German data was all right. Our data here in the US, fair, okay? But I think that economic data, maybe we see a couple of weekend numbers and all of a sudden we're talking about the yield curve again. And what I'm actually believe is going to play out in here, if you take a look at the TNX is the 10-year. And again, if you're not necessarily familiar with that TNX, the TNX, join us here in the 10-year Treasury. It's sitting right now about 1.77%, meaning the 10-year sitting at 1.77%. Personally, I think this is going to back off again. I think it's going to back off to about the 1.6%, somewhere in that neighborhood in the very near term. Again, the inclination for me believing this Okay, that's many-fold, but I think that some of the economic data out there is making us nervous. I'm also going to give you a little tidbit over here. Okay, if you take a look at EEM, some of the emerging markets are seeing some sell-side activity, whether it's EEM, okay, or FXI. By the way, both of these are heavily into Asia. FXI is actually China. I think the emerging markets and the pressure to the emerging markets themselves are actually going to cause our interest rates to possibly come off a little bit. And you're like, well, why? Why? Okay, well, I'll give you a pretty good reason. What's going to occur? Risk starts to proliferate inside of Asia. When risk starts to proliferate in Asia, okay, they're actually going to come in and they're going to buy our bonds. So they're going to come over here and they're going to buy our bonds. And if they buy the bonds, okay, buying bonds is going to take interest rates a little bit lower. I think we're actually going to come down again somewhere around 1.6% here in the near term. Why does that matter? Because you haven't heard anything about yield curve or inversions. And all of a sudden, what are we going to be talking about again? If the yield curve gets close to inverting again, which it will, we're going to be talking about what? Oh no, there's recession fears. And they're going to actually reignite the recession fears. With that, I've got a little TLT trade here on the side that I'm doing. TLT trade is really, really straightforward. So I'm doing an in-out spread. I'm going to buy the 139.50s, sell the 141.50s. Okay, that's your in-out spread. This is something that I've detailed a bit more in the in-out spread update for those of you that are members of TheoTrade. We're out of that one over there. When I say we're out of it, we'll allow you guys to take a look at that video for in-out spreads. It details all the different aspects of that particular TLT trade. So again, economic data, okay, leading to slightly lower rates, along with the fact that in the emerging markets, they're getting nervous over there. Now, on and upward to the capital rotation game. The capital rotation game is also feeding very heavily into this positive kind of feedback loop. We talk about positive feedback loop. I mean, listen, we got everything from expected move to the fact that the Fed's got your back, baby, okay, to interest rates. All of it is feeding into this, okay, positive feedback loop. And that positive feedback loop is just what we're seeing in the markets. I mean, the S&Ps, what are they doing? Just kind of grinding a little bit higher on a day-to-day basis. Nothing too crazy. Okay. And by the way, I define nothing too crazy. I know that we look at this rally and we say, that's the most ridiculous thing that I've ever seen. Like, look at it. Okay. That's the most ridiculous thing that I've ever seen. And then I stop myself for a second from saying that. And then I go back over to the SPX and I go, wait, every single one of these moves was inside expected. Nothing is ridiculous. Everything is statistically like perfect. And then you realize we've had 17 weeks without breaking through the expected move. And you're like, oh yeah, I'm a little bit nervous. But the capital rotation game on a week-to-week basis, all we're really seeing, if you actually take a look at like the XLF, okay, I was talking about statistical significance. I'm going to apply auto-expected moves, okay? In terms of statistical significance, what really, you know, when you start to like, you know, what bears down on what's significant and what's not, okay? Big breaches of expected move, like here, look at this, here, okay? It's been now really 3 weeks since we've actually breached expected move on the financials. The financials, and the reason I'm kind of looking at the financials, first of all, they haunt me. I've got a lot of positions in them, but the financials, okay, this hasn't been in the game, all right? In what? You got 1, 2, 3 weeks. The financials now have been right inside those expected moves. Okay, it was previous to that where we actually saw the financials break out to the upside, and that's actually what drove the S&Ps quite a bit higher. But this past week, if you take a look at like XLY, that's actually consumer discretionary. Okay, consumer discretionary. Just take a look. Consumer discretionary, people, it's done absolutely nothing. Okay, nothing in the last couple of weeks when the rest of the marketplace is rallying. All of a sudden, that's where everybody jumped to this week. So we're getting this like this house of horrors where they're actually just rotating, capital rotation game. I also just wanted to throw up, there was also the XLV. XLV, it had its week. All right. So XLV also, you know, breaking out a little bit in the last 2 trading weeks. And again, then we also had the monsters of tech. Each week, you kind of feel like you could almost pick out a sector, okay, and just go for it. Ironically, the monsters of tech, okay, there's been a constant kind of grind up here. But what's interesting also is this week, in this shortened week, the monsters of tech did actually crack outside their expected move to the upside. And the interesting irony of that is with this entire rally that's kind of persisted inside of the S&P 500, are you aware, okay, that tech also, okay, is not really effectively cracking outside of its expected move. It's been adhering very nicely to that expected move. So the last idea I want to give you, okay, in this kind of weekend's update, it's markets, they're going to correlate when we come out of the gamma trade. And that's effectively, right, this positive grind that we've been talking about this entire kind of session over here. Market correlations are not anywhere to be found in this. Okay, this is what? A whopping 10-point sell-off on a Friday. That's a half a trading session. That actually is one of the best degrees of correlation that we've seen in the S&P 100. Okay, kind of all the stars are starting to align. Now, when I'm talking about markets will correlate when they come out of this gamma trade, what I'm really looking for, right? And I'll get very specific in here, to the downside, you got to start to have 87 to even 90 products trade to the downside. To the upside, okay, like 85 products to the upside. I'm saying the advanced decline line should look something like, okay, 15 to 85. You want to see correlation, whether it's to the upside or the downside. It doesn't matter. When we are correlated, okay, this range and this constant grind, this positive feedback loop is done, all right? That would just be one of the confirming factors of it. But when you start to look at everything kind of compiled together, what's everything, all right? Everything is 17 weeks, okay, without a major breach of expected move. You've actually seen historical volatility kind of bottoming in some of the index products out there. The merry-go-round of horrors, specifically this interest rate, okay? And again, I believe the interest rate's going to back off a little bit, and we'll start talking about the yield curve again, the capital rotation game, which all of a sudden, okay, we're running out of rope on the capital rotation game. And again, the markets, the lack of correlation over here, look for the market correlation to kind of confirm when we do officially. It's not about cracking a range, okay? We're not in a range right now. We're just what? We're just heading higher. It's about getting risky. It's about getting wild. It's about markets starting to come apart at the seams, because right now, the efficiency in there is ridiculous, uncanny. 17 weeks without cracking through it. And we're calling for what? This market grind coming to an end. Thanks everybody for joining us here at TheoTrade for the weekend update. Have a wonderful holiday weekend. Bye-bye.